Stablecoins have quickly become a core part of the crypto ecosystem. They are widely used for trading, payments, decentralized finance, DeFi, and cross-border transfers because they promise price stability compared to volatile cryptocurrencies. However, as their usage grows, regulators and global financial institutions are paying closer attention to the risks they may pose to the broader financial system. This video is all about stablecoin systemic risk and reserve transparency. If you use stablecoins or follow crypto markets, understanding how they work and the risks behind them is now more important than ever. Let's get started. What are stablecoins and why they matter? Stablecoins are digital assets designed to maintain a stable value, usually by being pegged to a fiat currency like the US dollar. Unlike Bitcoin or Ethereum, their main purpose is not speculation but reliability. They act as a bridge between traditional finance and the crypto world, enabling fast transactions, lower fees, and easier access to DeFi services. Because of this, stablecoins now process billions of dollars in daily transactions. Their growing role means that problems in stablecoin markets can affect the entire crypto ecosystem. If users lose trust in a major stablecoin, trading pairs, lending protocols, and payment systems can all be disrupted. This is why regulators no longer see stablecoins as a niche crypto product but as financial infrastructure that could influence both digital and traditional markets. Understanding systemic risk in stablecoins. Systemic risk refers to the possibility that the failure of one institution or product could trigger widespread disruption across the financial system. In the case of stablecoins, this risk arises when a large number of users rely on a single issuer or token. If that stablecoin fails, panic selling and mass redemptions can follow. Because stablecoins are deeply integrated into exchanges, wallets, and DeFi platforms, a sudden loss of confidence can spread quickly. This contagion effect is similar to bank runs in traditional finance. Regulators worry that during market stress, stablecoin issuers may not be able to meet redemption demands, leading to frozen withdrawals and sharp losses for users. Reserve backing, the foundation of trust. The stability of a stablecoin depends heavily on the quality and transparency of its reserves. Ideally, every issued token should be backed by high-quality liquid assets such as cash or short-term government securities. However, not all stablecoins follow this model strictly. Some issuers hold a mix of assets, including commercial paper, corporate bonds, or even crypto assets. These instruments may lose value or become illiquid during financial stress. If reserves cannot be sold quickly without losses, the stablecoin's peg may break. This is why regulators emphasize that reserve composition is not just a technical detail, but a key factor in financial stability. The problem of opaque reserve disclosure. One of the biggest concerns raised by regulators is the lack of clear and frequent reserve disclosure. Many stablecoin issuers provide limited or delayed information about what backs their tokens. In some cases, disclosures are unaudited or based on broad categories that do not reveal real risk exposure. This opacity makes it difficult for users to assess whether a stablecoin is truly safe. During calm markets, this may not seem like a problem, but in times of stress, uncertainty can trigger panic. Regulators argue that real-time or near real-time transparency is essential to maintain trust and prevent sudden runs on stablecoins. Liquidity mismatch and redemption risk. Liquidity mismatch occurs when a stablecoin promises instant redemption, but its reserves cannot be converted into cash quickly. This creates a dangerous gap between user expectations and actual financial capacity. If many users request redemptions at the same time, the issuer may be forced to sell assets at a loss. Such forced selling can worsen market conditions and amplify losses. In extreme cases, redemptions may be halted altogether, damaging trust not only in the stablecoin but in the broader crypto market. Regulators see this risk as similar to money market fund stress events, which have required government intervention in the past. Stablecoins and contagion across crypto markets. Stablecoins are deeply interconnected with crypto exchanges, lending platforms, and DeFi protocols. They are often used as collateral, trading pairs, and settlement assets. This means that a failure in one major stablecoin can quickly spread across multiple platforms. For example, if a stablecoin loses its peg, collateral values drop, margin calls increase, and liquidations accelerate. This can cause sharp price declines in other crypto assets. In severe cases, losses may spill over into traditional finance through institutional investors, payment providers, or banks with crypto exposure. Concerns raised by BIS and IMF. Global institutions like the BIS and IMF have repeatedly warned that stablecoins could pose risks similar to those of unregulated banks. Their reports highlight issues such as weak governance, insufficient capital buffers, and lack of regulatory oversight. These bodies argue that stablecoins performing payment-like functions should meet standards similar to traditional financial institutions. This includes strong risk management, clear legal frameworks, and robust consumer protection. Their warnings reflect a growing consensus that stablecoins are no longer too small to regulate. Calls for bank-like regulation. As stablecoins grow, regulators are increasingly calling for bank-like rules. These may include minimum capital requirements, strict reserve rules, and limits on risky assets. Some proposals also suggest separating stablecoin issuance from other business activities to reduce conflicts of interest. The goal is not to stop innovation, but to ensure stability and protect users. By applying familiar regulatory principles, authorities hope to reduce the risk of sudden failures and maintain confidence in digital payment systems. The role of real-time auditing and reporting. Real-time auditing is emerging as a key solution to transparency concerns. Instead of quarterly or monthly reports, regulators want continuous verification of reserves. Advances in technology, including blockchain-based proof of reserves, make this more feasible than ever. Regular third-party audits can help confirm that reserves exist and match issued tokens. When combined with clear reporting standards, real-time audits can reduce uncertainty and prevent misinformation during periods of market stress. The future of stablecoins in a regulated world. Stablecoins are likely to remain an important part of digital finance, but their future will be shaped by regulation. Issuers that adopt transparency, strong governance, and conservative reserve management may gain long-term trust and wider adoption. At the same time, poorly managed stablecoins may struggle to survive in a stricter regulatory environment. For users, this shift could bring greater safety and confidence, even if it reduces some short-term flexibility. In the long run, balanced regulation may help stablecoins fulfill their promise without threatening financial stability. Stablecoins have moved from the edges of crypto into the center of global financial discussions. Their potential benefits are clear, but so are the risks. Opaque reserves, liquidity mismatches, and weak oversight can turn them into systemic threats during market stress. Regulators, institutions, and users all have a role to play in ensuring stablecoins remain stable. Before using any stablecoin, take time to understand its reserve backing, transparency practices, and regulatory status, because informed users are the first line of defense against systemic risk. That was all for today's video. Make sure to subscribe to our channel now and hit the bell icon for regular updates. Thanks for watching. Have a wonderful day.